Welcome to the deep dive. Today, we are getting right down to the foundations, the absolute bedrock of your financial life, your bank accounts. We've gone through dozens of reports, fee structures, and the latest rate shifts to really build a blueprint for you.
And it's so important because here's the uncomfortable truth. Most people are losing money every single month just by using the wrong accounts.
It adds up, doesn't it?
It really does. We're talking $20, maybe $50 a month between fees you shouldn't be paying and interest you're not earning. And over a lifetime, that's thousands of dollars. It's like you're paying this unnecessary tax just for, convenience.
So our mission in this deep dive is to get rid of that convenience tax.
Yeah.
We're going to demystify all the choices out there. Checking, savings, CDs, money market accounts, IRAs, the whole lot. By the end of this, you'll know exactly how to build that core foundation. A truly free checking account, a high-yield savings, and the right retirement account.
Okay, let's start with the Financial Command Center, the workhorse, your checking account.
It's built for speed, for frequent transactions, debit card swipes, bill pay, transfers. It's your daily driver.
But the trade-off has always been, well, you don't really earn any interest on that money.
Exactly, because it has to be ready to go at a moment's notice. But the real strategy with checking accounts isn't about earning. It's about not losing. The biggest enemy here is the monthly maintenance fee.
That 10 or 15 bucks a month.
That 10 or 15 bucks, traditional big banks love it. And they'll say, oh, it's waived if you keep $2,500 in the account at all times. But if you dip below that for even a day, boom, you're paying them.
But that's not the only option anymore. The landscape has totally changed.
Completely. You have online banks, credit unions. They don't have these massive, expensive branches on every corner, so they can pass that savings on to you.
In the form of genuinely free checking, no monthly fee, no minimum balance. It makes you wonder why anyone will keep paying that fee. Inertia is a powerful thing. But okay, avoiding that fee is step one. Step two is looking at the other costs, like ATM access. Does your bank have a good network? Or better yet, do they just reimburse you for any ATM fees anywhere?
That's a huge one. And what about overdrafts? That can be a nightmare.
It's a disaster. A $35 fee because you were short $5 on a coffee. And then if another bill comes through, it's another $35. It can cascade into hundreds of dollars in fees very, very quickly.
Whereas a lot of the newer online banks will just decline the transaction.
Or they'll pull it from your savings for free.
Yeah.
Which is so much better for you. It's a much friendlier system.
Okay, and on that daily use topic, we have to talk about the debit card itself. It's not as safe as a credit card for everyday spending.
Not at all. And this is critical. If someone steals your credit card number, they're stealing the bank's money. There's a firewall. But if they steal your debit card info,
they're taking money directly from your account, your rent money, your grocery money.
And getting it back can take days, sometimes weeks, while the bank investigates. It's a huge vulnerability. Our advice is simple. Use your debit card as an ATM key. That's it. For everything else, use a credit card.
Before we move to savings, what about specialized accounts, like for students?
Yeah, student accounts are great, usually for ages 16 to 24. No fees, low minimums. The only catch is you have to remember that when you age out, that free account will probably turn into a standard one with fees.
So you have to be proactive.
You do. And for people who've had some trouble in the past, maybe they're in check systems.
Which is like a credit report, but for banking.
Exactly. For them, there are second chance accounts. They're a vital way to get back into the system. They might have a few more restrictions at first, but they offer a clear path forward.
All right, let's shift gears from spending to growing. Let's talk savings accounts. These are for storage, for earning interest, and the big fork in the road here is traditional versus high yield.
And this is the aha moment. This is where you can make a huge difference with very little effort. A traditional savings account at a big national bank often pays. I mean, it's almost a joke.
It's like 0.01% APY.
Right, which means if you put $1,000 in, you earn 10 cents.
Yeah.
In a whole year.
Yeah.
Meanwhile, inflation's 2–3%.
Yeah.
So your money is actively guaranteed losing purchasing power.
It's just resting. It's not working for you at all.
It's not. And the reason is profit margins. Big banks rely on customers just not moving their money. But high-yield savings accounts, or HYSAs, mostly from online banks, are paying 3, 4, even 5% right now.
Okay, let's put some real numbers on that. That gap is massive.
It is. Take $10,000. Over 10 years in that 0.01% account, it grows by $10.
Total. Wow.
In a HYSA, let's say a conservative 4%, it grows to about $14,800. That is a $4,800 difference. It's free money you're leaving on the table.
And this is exactly where your emergency fund should be. It has to be liquid, it has to be safe, and with a HYSA, it can actually grow.
It's non-negotiable. A $15,000 emergency fund in a HYSA could be generating $600 a year. And it's all FDIC insured up to $250,000. There's no reason not to do this.
Okay, so once the emergency fund is set in a HYSA, what about money you know you won't need for a year? Or 5 years? That's where CDs come in, right? Certificates of deposit.
Correct. This is a trade-off. You're giving up liquidity for a higher guaranteed interest rate.
Yeah.
You lock your money up for a set term, and if you pull it out early, there's a penalty, usually a few months' worth of interest.
So how do you get those higher rates without locking all your money away for 5 years?
This is where a more sophisticated strategy comes into play. It's called CD laddering.
I like the sound of that.
Instead of putting, say, $25,000 into one 5-year CD, you break it up. You put $5,000 into a 1-year, $5,000 into a 2-year, and so on up to 5 years.
Ah, so you have staggered maturity dates.
Exactly. Now, every single year, one of your CDs matures. It becomes liquid. You can use that cash if you need it, or you can roll it into a new 5-year CD to keep the ladder going at the highest current rates. It's the best of both worlds.
And what about money market accounts? They often get confused with other things.
They do. A money market account, or MMA, is a bank account. It's FDIC insured. It's safe. It usually pays rates similar to a HYSA, but might come with a debit card or check writing privileges.
But it's different from a money market fund.
Very different. A money market fund is an investment, not a bank deposit. It's offered by a brokerage. While they are very safe, they are not FDIC insured. For your core cash savings, you want the FDIC insured account.
Got it. Let's pivot now to the long term. To accounts designed for big goals, which means we have to talk about tax advantages. Let's start with IRAs, individual retirement accounts.
The big question with IRAs is simple. Do you want to pay taxes now, or do you want to pay them later? That choice leads you to the two main types.
Traditional and Roth.
Right. A traditional IRA is for pre-tax dollars. You get a tax deduction on your contribution today, the money grows tax-deferred, and then you pay income tax when you withdraw it in retirement.
And the Roth IRA is the mirror image.
It's the exact opposite. You contribute with after-tax money, so no deduction today,
Right.
but then it grows completely tax-free, and all your withdrawals in retirement, your contributions, and all the gains are 100% tax-free.
The choice there really depends on your income now versus what you expect it to be later on.
It's a strategic bet on your future tax bracket. And even though the contribution limits seem modest, around $7,000 a year, starting early and maxing that out every year creates an incredible compounding machine inside that tax advantage shell.
No. Let's talk about what some people call the undisputed king of savings accounts.
Yeah.
The health savings account, or HSA.
If you're eligible, and that means you have to be on a high-deductible health plan, it is an unbelievable tool. It's the only account with a triple tax advantage.
Okay, break that down for us.
1, your contributions are tax-deductible. 2, the money grows completely tax-free. And 3, your withdrawals are also tax-free, as long as they're for qualified medical expenses.
Nothing else does all three of those things.
Nothing. And what's really amazing is that after you turn 65, it effectively becomes another retirement account. You can pull money out for any reason, not just medical, and you'll just pay ordinary income tax on it, just like a traditional IRA.
That's incredible flexibility.
It is. A lot of savvy people actually pay their current medical bills out of pocket and just let their HSA grow untouched as a long-term investment vehicle for retirement.
Let's touch quickly on a couple of organizational accounts. Business checking for anyone with a side hustle?
Non-negotiable. You have to separate your personal and business finances. It's crucial for legal protection and for making tax time sane. Don't mix your funds. It's the #1 mistake.
And a simple one for estate planning, the POD or TOD designation.
Payable on death or transfer on death. It's a simple form you sign at your bank. It names a beneficiary for your account. When you pass away, that money goes directly to them, completely skipping the long and expensive probate process.
So simple, but so powerful. Okay, let's talk about where to bank. We've mentioned big banks, online banks. What about credit unions?
Credit unions are a great option. They are nonprofit cooperatives owned by their members. Their whole mission is to serve you, not outside shareholders.
Which usually means better rates.
Better rates on savings, lower rates on loans, fewer fees. The only catch is you have to be eligible for membership, which is often tied to your job or where you live.
And then the pure online banks, whose main advantage is just cost.
Their whole model is built on value. New branches means low overhead, which means they can offer those incredible HYSA rates and free checking. The trade-off, though, is it's hard to deposit cash, and you don't have a person to talk to face-to-face if something goes wrong.
Let's drill down on fees. The goal is to pay zero.
Your goal is to pay zero. Banks use fees to make a profit. You need to choose a bank that doesn't need your fees to operate. So, no monthly maintenance fees, find a free account,
No overdraft fee.
get an account that just declines the transaction, no ATM fees, find a bank that reimburses them nationwide.
And no wire transfer fees unless it's absolutely necessary.
Right, for something like a house closing. For everything else, use Zelle or an ACH transfer. They're free. Avoiding these fees is like getting a risk-free, tax-free return on your money.
We can't wrap this up without talking about security. The threats are getting more and more sophisticated.
They are. The one that really worries me is the account takeover. A criminal gets your password, logs in, and immediately changes your email and phone number on the account,
Locking you out.
locking you out while they drain your funds. It's terrifying.
So let's give everyone some hard, actionable steps. Number one has to be two-factor authentication.
Yes, enable it everywhere, but be specific. If you have the choice, use an authenticator app like Google Authenticator or Authy instead of getting a text message.
Why is that?
Because text messages can be intercepted through a scam called SIM swapping. The Authenticator app is much more secure.
Okay, what's next?
Constant monitoring. Check your accounts weekly, at a minimum. Set up alerts for any transaction over, say, $25. The faster you spot a problem, the easier it is to fix. And, of course, use a password manager. Long, unique, complex passwords for every single site.
So when we put this all together, the big takeaway is that your bank accounts should be working for you, earning you money, simplifying your life, not costing you in fees.
Absolutely. The difference between that 0.01% account and a 4% HYSA is tens of thousands of dollars over your lifetime. It's passive income for making one smart choice.
The best products are no longer niche. They're available to almost everyone.
They are. Free checking and high-yield savings are the new standard. If you are paying monthly fees or earning next to nothing in interest, you have the blueprint now to change that. Your optimal financial foundation is right there, waiting for you to build it.
And as you think about where to put those long-term savings, here's a final thought to leave you with. Considering the strict rules on required minimum distributions, or RMDs, that kick in for traditional IRAs at age 73, and the income limits on contributing to a Roth IRA today, have you really calculated which account will save you the most money when you actually stop working? That decision, tax now versus tax later, could have shaped how much wealth your heirs ultimately receive and whether or not they get it tax-free.